Hey, what's going on YouTube? In this video, we're going to go over Hims and Hers Health, ticker symbol HIMS. They just reported their Q3 earnings. They beat on revenue, but slightly missed on EPS. And analysts for the next quarter have all revised their expectations higher. All six of them revised their expectations higher for next quarter. They do have 10.2% short interest against the company, and I don't believe that is going to hold up for very long based on the financials once we get to them. They're not all sunshine and roses, but they are pretty solid financials. Year to date, company is up 16.4%. Of course, the 1 year is up 18.9%. This company supplies health and wellness products and some services as well. And there's also recurring subscriptions that you can also apply for through probably a doctor of some kind that can issue a prescription to you. However, the more important side of things here is going to be the earnings. So company did issue a $50 million buyback, stock buyback, but once we get into cash flows, we'll soon figure out that that is not that big of a deal. But at the end of Q3, they had about 1.4 million subscribers. That is up 56% from 1 year ago. That's very, very solid. However, average subscriber revenue per subscriber fell by about 4%, now down to about $54 per subscriber per month. So last quarter, they were able to raise their gross margins from 79% to 83%. So very good margin growth rate there. Probably not going to be able to squeeze too much more out of that margin growth. I can't imagine. Maybe they can, but probably not a whole heck of a lot more. For the fourth quarter, they're expecting revenue of $243 to $248 million. And this most recent quarter, they produced $226 million. So still producing some very solid revenue growth, about 10% roughly of revenue growth rate there. So very good. So over to the financials on this company. We will go over their most recent 10Q after we do these financials real quickly. So revenue, gross profit, net income. We can see where revenue and gross profit are headed. Doesn't seem like those are going to be stopping anytime soon. Revenue is starting to find its way back up and follow suit with the revs and gross profit. We'll do a little math here on the 10Q in a little bit and potentially forecasting in the next 12 months that this company could potentially be seeing positive net income, which is very exciting. Gross margin sitting at 82.6% based on last quarter results, and we can see margins just kind of continue to grow. Eventually, those are going to stop. You can't have 100% gross margins. Net margins, they are, again, they're growing with everything else. They're starting to hopefully start to see a positive net income, net margins sometime next year, possibly. Growth on the company is still sitting at about 50% growth on revenue and gross profit. Return on invested capital, currently negative, but heading in the right direction. PE ratio, currently company is negative on earnings per share, but we will do a little math and figure out roughly what the future EPS could be on this company. And then that way we can figure out a fair market value on the company today. So cash to debt, company's balance sheet is solid. The company's got way more cash than even just total debt. Currently total debt is $85 million and cash $212 million. Very solid. Net income to free cash flow produces negative net income, but positive free cash flow. And as we can see, a good chunk of that is going to be stock-based compensation. So even if they do that $50 million share buyback, it's only covering only part of their stock-based compensation. So it's not really going to do too much to the overall dilution. Free cash flow, they are obviously positive free cash flow. Capital expenditures only negative $18 million, so not terrible on CapEx. Share count dilution sitting at 210 million shares currently, but depending on how they continue doing share buybacks, or maybe they'll throttle back on stock-based compensation, we'll probably continue to see dilution within the company. Over to the 10Q, we've got our balance sheet here. So right off the bat, we've got $212.5 million of cash and short-term investments combined. Cash growth in the last 9 months was roughly about $30 million, so very good. Down here, we can cross off deferred revenues of $4.4 million. At least that's what I do. And then that gives us a just complete total debt of $81 million. And we've got $212 million in cash. So that is a very solid balance sheet. Always a company worth digging deeper into when they got a balance sheet that always is positive cash. Income statement here, we've got revenue sitting at $227-ish million in revenue. Cost of revenue, about $40 million. Then we've got our gross profit of $187.3 million. Increased margins by 4% year over year. So very good there. They are still marketing this their products pretty heavily, which is fine, totally fine, especially when you want to see them grow and turn into a positive net income company. You definitely want to see them market their products. So totally okay with the additional marketing expenses. However, would like to see, like, typically with a smaller growing business, it's possible that they could find some things to cut back on and cut out of their business to reduce their overall operating expenses. And maybe it's too soon for that for them. Maybe they need everything they've got. And then going forward, maybe they can start to trim off whatever they feel is not necessary to have. But overall, then, minus out taxes, we've got a net loss of $7.6 million compared to last year of negative $18.8. Now, onto the cash flows. So we've got negative in the last 9 months, negative $25 million. Add back in depreciation, add in $48 million of stock-based compensation. So basically, that share buyback is irrelevant. It really doesn't going to do anything. It's just going to cover 9 months worth of stock-based compensation, basically. So then you got other cash flows within the business, and then that leaves you with about $51.5 million positive cash from operations. Basically, you can just say majority of that is going to be from your stock-based compensation. So stock-based compensation basically gives us a positive cash from operations. We subtract out our CapEx of $8.6 million. That leaves us with $43 million in free cash flow. Now, here's where things could change. So right now, a company is negative earnings per share. So currently, company has $1.4 million, 1.4 million subs and makes roughly $162 per customer per quarter. Okay. And revenue is currently at $226.7 million. So if we say the growth rate on customers go from 56 to 40%, that would still grow subs to roughly just shy of 2 million subs in total times $162 per quarter. That's $317 million. So if operating expenses, let's say, increase another 10% from where they're at, that would be $215 million of operating expenses increased. I can't imagine operating expenses are going to increase too much more. That could be an incorrect assumption. Obviously, all this could be very incorrect, but we're deducting 17% from subscriber growth, and we're expecting a pretty significant slowdown in operating expenses as well. But let's assume that's where they could potentially end up. Eventually, those operating expenses will slow down. So then we have $317.5 million times 82% margin gives them $260.3 million. Then you subtract off your operating expenses of $215. That leaves you with $45 million minus taxes and all these other things. But they do have a little bit of other income as well. So we'll just call it $30 million per quarter for total annual net income. That would then leave them with a positive net income of $120 million in 1 year. And this subscriber growth would just be for next year. This is 40% growth. So last year they did 56% growth. And maybe this next 12 months, they'll do 40%. And by that time, this time next year, they'll see a full 40% growth rate. And this is potentially the numbers we could maybe see, right? Obviously, they're not going to just jump to 40% increase tomorrow. It's going to take the course of a year to grow that subscriber count. But this time next year, we could potentially see an annual net income of about forecasted, at least of about roughly $120 million. So this is like kind of forecasting this time next year, they'll be sitting at 40% more subscribers and then add 12 months. So basically, you're looking 2 years out. You could potentially see an annual net income of $120 million. Add about 208 million shares, depending on how that share count works out. Obviously, they could keep diluting. They might. That gives us an EPS of 57 cents. So obviously there's a lot of unknown factors in there. We're just kind of really just ballparking this. It's really all we've really got to go with. So if we plug in an EPS of 57 cents per share on this company, and then we plug it in over here to our calculator, we got 50 cents EPS. We're not going to worry about anything else. And we have an EPS growth rate going forward of 17%. That gives us a fair value, Peter's fair value of $9.69, a Graham's valuation of $11.40, a discounted cash flow. This is an accurate number based on today, actually, would be a DCF price per share of $9.46. So this would be a today's number, actually, is a DCF based on today's number. Obviously, we're not forecasting out any free cash flow beyond where it's at today. So right now we're forecasting 25% growth on free cash flow. Gives them a discounted cash flow price per share today of $9.46. So Rule 72, we have two sources of EPS growth rate for a combined amount of 16% growth on EPS. And then that goes into 72, 4.6 times. That goes into 10 years, basically 2 times. So we get to double our current EPS 2.3 times. That gives us a future EPS of 2.3. That then gives us a fair value of $18.02 per share. Now over to the summary. We currently it's trading at $7.71. Fair market value $12.14. 30% margin of safety $8.50. And wow, analyst price target of $12.64. Basically right in line where we are. So pretty solid. That would be my 18-month expectation on this company. This is not a today number. This would be something that would be valued about 12 to 18 months from now. So over to the stock chart on HIMS, we've got this thing. So just reported their earnings. We can see last week this big green this big green volume bar, a little bit of a green candle as well on the weekly. We can go to squeeze down to the daily and see how that reacted. So big pop up, moved up, pulled back, and since actually has rallied back up higher. So this one to me is very interesting. So it's set up at the bottom of the channel there just prior to earnings. And then, once earnings popped out, it came out, broke through another channel, and is now resuming and confirming higher lows, especially on the weekly chart. We can see lower, higher low, another higher low. This one could potentially resume back up to about, 11-ish dollars per share in the near future. And then once it does that, reassess the overall financials on the company and see if this thing is still holding up and still on track for continual growth on the subscriber count. And revenues continue to grow and margins are staying consistent. And maybe they can even squeeze a little bit more out of their margins and grow those just a hair more. But overall, on the company, financials are solid. The only thing I'd really like to see is a reduction in their overall stock-based compensation, because otherwise you're just going to continue to get diluted as a shareholder. Obviously, that's less than ideal. But overall, pretty solid company. I am a big fan of the financials, and I think this is one worth your time to dig deeper into. Spend at least another 30 minutes and figure out if this is a company that fits your portfolio or not. But that is it for this company. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.